John, good to see you. Diving into the headlines a little bit today, should you buy risky assets in your 401k? Potential changes could be coming to your workplace retirement plan. That's because President Trump recently signed this executive order that would pave the way for riskier assets to be included in your 401k. What's new here?
Well, just like you said, uh, it paves a way for new asset classes to be inside 401ks, specifically private equity and alternative investments that, can carry some potential, great potential, but have a lot of risk involved in them that I think the normal 401k participant may not feel comfortable with.
hmm You mentioned private equity. What is private equity exactly?
So private equity is essentially you're investing in a private company
hmm
whose goal is to purchase that of another company, make it more profitable, and sell it. So let's use a simple analogy. You and your buddies are general partners or limited partners. You see a nice rundown house. You saw, you've been watching, you've been binge watching the Do It Yourself channel, and you're like, "Wait, let's fix her and flip her." So you go in and you renovate this house, you fix it, and then hopefully with the money you've put in, your purchase price, your sweat equity and all that, and the cost of fixing it up, you sell it for a profit. They make it look so easy on TV, right?
They do.
The problem is do you want to gamble with that in your retirement? And what people have to understand is private equities, they're not like listed stocks or mutual funds or ETFs. You're buying into this private company, it's illiquid. And I kind of get it's a little bit of a conundrum because your 401ks for the most part are illiquid. But I'm not a big fan of a lot of illiquid investments. And you have to understand that these are very complex. And
hmm
these companies can be less transparent than the
Right.
normal investments you're in.
Right. Right.
So I wouldn't put them in my companies that I manage their 401ks because for the vast majority of 401k participants, they just want simplicity, and
Mhm.
this is far from it.
Right. So, what are the risks and rewards, though, of these alternative investments? Because we all have fear of missing out, John.
Yeah, well, I mean, the good thing about the fear of missing out is, unless someone's in it and they're bragging at the office, it's not something that's going to be posted on, the 5 o'clock news like the S&P 500, Dow Jones, and Nasdaq are thrown in our faces every day. The risk is, hey, this private equity firm, bought a struggling company, and all of a sudden they turned it into a monster company and sold it for a large profit. Or like I kind of said in the fix it and flip it, yes, these guys are professionals, but the investments don't go as planned, and you lose what you put in. Not to
hmm
mention, what we're going to talk about here next.
Right. Yes. And my next question is specifically regarding fees because private equity funds typically charge a 2% management fee plus 20% of profits. It's known as the 2 and 20 model. In a 401k, fees like that can be devastating over time. And critics say the biggest beneficiary of this rule change will be the companies that offer them, not the plan participants. What do you think?
Yeah. I mean, that's a lot of money.
Yeah.
Um, Cost becomes an issue when there's an absence of value. And for normal 401k people who want simplicity, I just don't think they're going to see that. So let's go back to that 2 and 20 rule. So let's say you're investing in this company at 2% fee. That's expensive. That's expensive. And a lot of people don't even understand the real cost within their 401ks to begin with. So 2% plus any other plan administration fees or top, that's a lot of money when you compound that over, however long, you have this investment. But then you have the 20% of profits go back. So let's just, go gross of fees and net of fees. You have a 10% return 1 year, Aaron. Take off your 2% expense ratio for the cost of doing business. Now it's an 8% return. And they're keeping 20% of the profit. So let's just make that simplicity and say, well, you got a 10% return. They're keeping, another 2% of that. all of a sudden it's your money you're investing and you're at a 6% return when the fund's returning 10%. That's just the cost of doing business with the fund.
So then, John, the question boils down to who should consider buying risky assets in their 401k?
Someone who is extremely diligent. I mean, I really don't know how many plan administrators or advisors are going to put this in there. Maybe, for some very high end 401ks. But if you're going, most 401k company people have to understand they are the advisor on their policies, right? They're making the investment decisions. In most cases, I see a lot of people that just bought target date funds because they want a plug and play. They want simplicity. In with my company 401ks, we offer models that say, hey, this is not a target date fund. This is a diversified model. Again, plug and play. And 98% of my participants use that. People want simplicity. They have a job. It's not investing. They don't want to do that. If you're going to invest in this, you have to understand this company can be less transparent. You have to understand the fees. You have to read that novel of a prospectus. Absolutely, this is not something you wing. When we also talk about riskier investments, something that we haven't really talked about because we focused on the private equity, crypto, the ability to have crypto inside 401ks is now becoming mainstream. I will say, this you could consider as long as it's a crypto ETF and it's liquid and you can sell it, at any time you want. I think nowadays the mainstream, the Bitcoin, the Ethereum, we're not talking about doggy coin or whatnot. It's becoming more and more of a reality to have. Now you have to understand that Bitcoin is volatile, right? It can spike up one day and it can drop the other. So you have to go in with the mindset of, I can lose all this money, but I can also make a lot of money, right? That risk reward. However, if you just took 1 to 3% of your portfolio, and I just put out a newsletter for my clients today saying, listen, when our signals state, we are going to buy some of these crypto holdings because it can have a substantial impact. And if you put 1%, there was a couple studies done on this over the years that if you put a 1% holding into crypto and it went to zero, that it's really going to have a negligible effect on your portfolio. You might lose 1% or so, not going to kill you. However, if you hit crypto, and we've seen these big crypto swings, even this year, and crypto really shoots and you have a big return in crypto, that 1%, if you had a 7% return on your portfolio, it could easily double it. So, I think that in the risk reward is a little bit more tangible and feasible to do than, hey, let's dive into the world of private equities and private placements like we're watching Billions on HBO.
No, but it is interesting to talk through, John. And I do appreciate, again, having you as a resource. Friendly reminder to everybody that all of your financial questions, you can probably find answers to them on John's YouTube channel. But John, if somebody wants to sit down and discuss, whether they should be investing in alternative investments, what's the best way to reach you?
Yeah, well, you mentioned it. Visit our website, www.gosecurus.com. I don't even know. I think we've got over 100 videos easily, Aaron, plus my podcast, which is over 100 podcasts where we dive into details with my good friend Tom O'Connell, the Retire Happy podcast. But while you're looking for answers and searching for knowledge on my website, if you want to set up an appointment, head over to the Contact Us tab. And you can schedule a 20-minute phone call where I will answer any general questions for you during that period. Or if you want more in-depth and are looking for help, you can schedule a 1-hour complimentary vision and clarity consultation, and we will meet with you.
Great. John, thank you.
Thank you, Aaron.